All right, listen up. According to recent reports, only about a quarter of crypto investors are voluntarily complying with their tax obligations, meaning over 75% are screwing up their taxes so badly they're leaving thousands of dollars on the table or setting themselves up for audits that'll make a root canal feel like a spa day. And here's the kicker. Most of these mistakes are 100% avoidable. So if you've been treating your Bitcoin taxes like some boring side quest you'll deal with later, congratulations. You're probably hemorrhaging cash right now and don't even know it. But buckle up, because today we're about to fix that. I'm breaking down the single biggest Bitcoin tax mistake that's quietly draining American investors' bank accounts, and more importantly, I'm handing you the exact playbook to stop it. Legally, strategically, and without needing a PhD in accounting. This isn't some dry tax lecture either. We're talking tax loss harvesting hacks, record-keeping systems that actually work, and optimization strategies that'll have you feeling like you just unlocked cheat codes for the IRS. Let's get into it. Quick heads up. This is for educational and entertainment purposes only, not financial advice. Do your own research, folks, and consult a pro before making moves. So what's the big mistake? It's this. Most Bitcoin investors are ignoring tax loss harvesting like it's some Wall Street fairy tale that doesn't apply to them. Wrong. Dead wrong. Tax loss harvesting is the art of strategically selling your losing positions to offset your gains. And when it comes to Bitcoin's wild price swings, this isn't just some fancy trick for hedge fund bros. It's your secret weapon to legally slash your tax bill by thousands. Here's how brutal it gets. Let's say you bought Bitcoin at $90,000 back in early 2025, then panic sold at $70,000 during a correction. Ouch, right? That's a $20,000 loss per coin. But here's where it gets spicy. If you also sold some Bitcoin you bought at $50,000 for $100,000. Later that year, you're sitting on a massive taxable gain. Without tax loss harvesting, Uncle Sam's coming for his cut on those profits, and he doesn't care about your losses unless you tell him. But if you're smart, you use that $20,000 loss to directly offset your gains, potentially saving yourself thousands in taxes. And if your losses exceed your gains, you can deduct up to $3,000 against your regular income every year and carry forward the rest indefinitely. That's literally free money you're leaving on the table by doing nothing. Now, I know what you're thinking. Isn't there some wash sale rule that screws this up? Here's the beautiful part. And this is where Bitcoin becomes your best friend. The IRS wash sale rule, which prevents you from claiming a loss if you rebuy the same asset within 30 days, currently doesn't apply to crypto. That's right. Bitcoin is classified as property, not a security, so you can sell at a loss, harvest that tax benefit, and buy back immediately if you want. It's the ultimate loophole, and it's 100% legal for now. Congress keeps eyeing this, so smart investors are taking advantage while the window's wide open. But here's where most people faceplant. They have zero clue what their actual cost basis is, so they can't even calculate their losses properly. And that brings us to mistake number 2 within the mistake: garbage record keeping. If your record-keeping system is a chaotic mess of exchange emails, random screenshots, and vibes, you're cooked. The IRS requires you to track every single transaction. When you bought, how much you paid, when you sold, and what you got for it. Every single trade. And if you've been DCAing into Bitcoin weekly, trading between exchanges, sending to cold storage, or heaven forbid, buying coffee with Bitcoin back in 2017, you've got potentially hundreds or thousands of transactions to track. Here's the thing. Most Americans are using 5 different exchanges, and none of them talk to each other. Coinbase doesn't know about your Kraken trades. Kraken doesn't know about your cold storage moves, and your cold storage definitely isn't filing any paperwork. But heads up, starting with tax year 2025, brokers like exchanges are required to report gross proceeds from your sales on the new Form 1099-DA, which is a step in the right direction for easier tracking. Cost basis reporting kicks in for 2026 and beyond, so for now, you're still on the hook for the full details. When tax season rolls around, if you're not prepared, you're sitting there with a calculator and a prayer trying to reverse engineer your entire Bitcoin history. And guess what? If you can't prove your cost basis, the IRS can assume it's zero, meaning they'll tax you on the entire sale amount. That's not a typo. They can tax you like you got every Satoshi for free. Talk about a nightmare. So what's the fix? You need a system, not a shoebox full of receipts. At minimum, you need crypto tax software. Platforms like CoinTracker, Coinly, or TaxBit that automatically pull your transaction history from exchanges and calculate your gains, losses, and cost basis using IRS-approved methods. These tools aren't perfect, but they'll save you from going insane and potentially save you thousands by catching opportunities you'd miss manually. And here's the pro move. Reconcile everything quarterly, not once a year in a panic. Set a reminder every 3 months to download your reports, check for errors, and make sure nothing's missing. Future you will worship past you for this. Now let's talk about cost basis methods, because this is where you can get seriously tactical. The IRS lets you choose between methods like FIFO, first in, first out, or specific identification, where you handpick exactly which coins you're selling. And this choice matters way more than you think. Let's say you bought one Bitcoin at $40,000 2 years ago and another at $90,000 last month. If you sell one Bitcoin today at $80,000 using FIFO, you're sitting on a $40,000 gain and a fat tax bill. But if you use specific identification and designate that you're selling the $90,000 coin, that's a $10,000 loss you can harvest. Same sale, completely different tax outcome. Wall Street's been playing this game for decades. It's about time Bitcoin investors caught up. And speaking of getting tactical, let's talk timing. Tax loss harvesting isn't just a December thing, even though everyone panic Googles it on New Year's Eve. The real pros are watching for opportunities year-round. Bitcoin dips 15% in a random Tuesday sell-off. That might be your tax loss harvesting moment. Sell the position at a loss, lock in that deduction, and if you still believe in Bitcoin long-term, which, let's be honest, if you're watching this video, you probably do, buy back in immediately. You've just turned a painful drawdown into a tax asset, and you're still holding the same amount of Bitcoin. That's big brain energy right there. But wait, there's more, because tax optimization for Bitcoin goes way beyond just harvesting losses. Let's talk about holding periods. If you're flipping Bitcoin like you're day trading GameStop on Wall Street bets, you're getting crushed by short-term capital gains taxes. That's your regular income tax rate, which for most Americans is somewhere between 22% and 37%. Absolute madness. But hold for more than a year? You drop into long-term capital gains rates, 0%, 15%, or 20% depending on your income. That's potentially half the tax bill or less, just for being patient. If you're buying Bitcoin as a long-term inflation hedge against the dollar's endless printing spree, this should be a no-brainer. Stack sats, hold, and let time do the heavy lifting on your tax burden. Now, here's a curveball a lot of people miss. Charitable donations with Bitcoin. If you've been holding Bitcoin for over a year and it's appreciated, donating it directly to a qualified charity lets you deduct the full fair market value without paying any capital gains tax on the appreciation. Let's say you bought Bitcoin at $10,000 and it's now worth $80,000. If you sell and donate the cash, you're paying capital gains tax on that $70,000 profit first, then donating what's left. But donate the Bitcoin directly? You get the full $80,000 deduction, avoid the capital gains hit entirely, and the charity gets more. It's a win-win that feels like you just discovered a cheat code. Churches, nonprofits, even some universities accept Bitcoin now. Use it strategically. If you're nodding along thinking about your own setup, what's one thing holding you back from getting your Bitcoin taxes dialed in? Share in the comments. I'm curious what roadblocks people are hitting. All right, let's get into the nuclear option for the true believers, retirement accounts. Did you know you can hold Bitcoin in a self-directed IRA? Yeah, we're talking Roth IRAs, traditional IRAs, even 401ks if your employer's cool. This is the ultimate long-term play. With a Roth IRA, you contribute after-tax dollars, but all the growth, including Bitcoin mooning to infinity, comes out tax-free in retirement. Zero capital gains. Zero income tax. Nada. You're basically building a tax-free Bitcoin fortress. Traditional IRAs and 401ks give you the tax deduction upfront, then you pay taxes on withdrawal, but either way, you're dodging the yearly capital gains headaches and compounding tax-free. The setup's a bit more involved. You need a custodian that allows crypto, but for long-term holders, this is the holy grail. And here's one more gem before we wrap. Keep immaculate records of everything, and I mean everything. Every wallet address, every transaction ID, every exchange login, every private key backup location. Document it all. Not just for taxes, but for your heirs. If something happens to you and your Bitcoin's locked in cold storage with zero documentation, that wealth's gone forever. The IRS might not care, but your family definitely will. Create a secure, encrypted record, or use a service designed for crypto estate planning. Think of it like a treasure map, except the treasure is your financial freedom and your family's future. So let's bring it home. The Bitcoin tax mistake costing you thousands isn't just one thing. It's a combo of ignoring tax loss harvesting, keeping trash records, not optimizing your cost basis method, and treating taxes like an afterthought instead of a strategic advantage. But now you've got the playbook. Harvest those losses year-round, lock in your record-keeping system, choose your cost basis wisely, hold for long-term gains when it makes sense, and explore advanced moves like charitable donations and retirement accounts. The IRS might be inevitable, but overpaying them sure as hell isn't. If this video just saved you thousands in taxes you didn't even know you were losing, smash that like button. It helps more people find this. Subscribe for more Bitcoin firepower that cuts through the noise, and hit the bell so you never miss a drop. Share this with your crypto crew who are probably making the same mistakes, and let me know in the comments. What's your Bitcoin hot take? Or what tax strategy are you running this year? Let's keep the conversation going. Now get out there, optimize those taxes, and keep stacking those sats like the freedom-loving, dollar-skeptical legends you are.